Welcome back. Investors in North American markets are looking at some pretty big numbers as 2024 draws to a close. The TSX Composite up by more than 20%. The S&P 500 well more than 20% is the gain. These are returns over 52 weeks, which is pretty close to being 2024 to date. Our next guest he's optimistic about economic growth in the world in 2025. However, he notes that the next year is not without challenges, and he's got an interesting idea or a strategy on rebalancing, in essence, trim U.S. and allocate to Canadian equities. Philip Petursson is our guest, Chief Investment Strategist at IG Wealth Management. Philip, good to see you.
Good to be here.
So we just had a bit of a chat before we came on camera. You are constructive on U.S. economic growth, and of course the U.S. is the largest economy in the world, can affect other economies around the world.
Exactly. When you look at the U.S., it is the benchmark. You start there. Largest economy, how is it doing? Because that will spill over into other areas. And going into 2025, we see the U.S. economy as being stable, fairly solid, all things being equal. Now, that doesn't take into consideration the impact of potential tariffs and what that might do not only to the U.S. economy, but to the global economy. That aside, without knowing where we're headed with tariffs at this point in time, we are optimistic.
Do you make any call on tariffs at all? The Wall Street Journal earlier this week reported that CEOs of major U.S. corporations are imploring Donald Trump not to proceed with what he's sketched out on social media, which is very steep tariff barriers applying to Canada, Mexico, China, and likely other countries as well. Does IG make a call on where this is going?
We're not very good in terms of the political landscape. That's not our specialty. However, if we have to sit there and rationalize this in terms of what Donald Trump's ideology, if you can attach an ideology to him at all. What is it? It's about a strong economy, a strong U.S. economy, and strong stock market. So tariffs would go against that. So if we have to take a layman's view of it, we would say it's unlikely that he would go forward with it. It's a negotiating tactic right now. It's a threat right now. But I don't think he's going to follow through with that threat.
Any quick thoughts on the developments in Ottawa yesterday, the enormous run-up in the deficit and the abrupt resignation of our finance minister?
Well, the first thing is markets hate uncertainty. And if anything, this creates a lot of uncertainty in Canada in terms of, are we waiting a year before the next election, or is it going to be rushed given a forced departure of our prime minister? Don't know, but you're seeing the impact on the dollar. We're seeing foreign investors lose confidence in the Canadian landscape, and that's pushing the dollar weaker. And a breakthrough 70 cents, I think, is a definite probability.
We're almost there right now. And in fact, this morning we have been at 69 and change. Let's go to your strategy. You and your team believe trimming some exposure in the U.S. is a wise thing to do at this point, and adding some exposure right here in Canada.
Exactly. So we saw the gains on the U.S. side, very, very strong gains, and it has been broadening out a little bit, but when you look at valuations are also very, very high in the United States. We're on the S&P 500, the NASDAQ, and so trimming some profits here is a good thing. That is a prudent thing. And with some of the uncertainties that we see in 2025, we're optimistic, but you can't deny some of the risks. Being a little bit more balanced in your portfolio across equities and fixed income is a prudent thing, and that would lead us to, hey, trim some of the higher valuation areas and put them to areas that could see some positive catalysts into 2025.
Which sectors do you think would bear trimming in the U.S.? Technology?
Technology, definitely. I think we were looking at consumer discretionary. That's an area. Basically, all but two sectors are at elevated levels in the United States right now. The two that are still at reasonable valuations are energy and financials. So definitely technology, definitely industrials, definitely consumer discretionary. Those are key areas that we would want to trim back.
Are you constructive on U.S. financials?
We are. So U.S. financials, and we would apply that to Canadian financials as well. We're seeing a re-steepening of the yield curve just in the last couple of weeks. We've seen the yield curve steepen out a little bit more. I think as the yield curve continues to normalize, this is good for bank profitability, and the banks reflect very, very attractive valuation.
And I was going to ask you, where would you allocate to in Canada? It sounds like Canadian banks are one area.
Exactly. Canadian banks, we still think that they have a way to run in 2025. Energy materials are the other two sectors that we are attracted to right now. And these have nothing to do with the Canadian economy, more to do with the global economy and catalysts that we think will drive energy prices higher, as well as base metals higher into 2025.
the second half of this year has been pretty dreary for oil prices, and lately, over the past week or so, we've seen the big oil producers, the likes of Canadian Natural Resources and Suncor, slide significantly. We can put those graphs up on the screen as well. Let's circle back to energy. Why are you constructive on the commodity price and the share prices?
Well, share price is one thing. One, they're reasonable valuation. Companies are buying back stock at record levels, and they are increasing their dividends and pay an attractive dividend yield. So just on the valuation side alone, energy is attractive. We think that energy is a good hedge against geopolitical risk in the Middle East. So we don't think there's a lot of downside. In fact, we think there's a significant margin of safety in energy right now. But if something was to transpire, whether it's the Middle East or perhaps other areas around the world, energy can be a hedge against that.
Do you see gold rallying further in 2025 and taking the share prices of producers with it? Exactly,
yes. We do see gold higher. We've got a target of 3,000 for gold. I think that that's reasonable, given where we are today. And if you look at it, the retail investor hasn't really been participating in gold's run up. I think that can follow in 2025. It's mostly been the central banks that have been driving the price of gold higher. So when you think of where gold can go and what can benefit from it, definitely the gold miners have benefited from it, and I think can continue. They're not overly expensive at this point in time yet.
Philip,